One. What's up, mortgage coach community? Dave Savage here, and I am interviewing Sean Johnson. What's up, Sean?
Hey, Dave, how you doing?
I'm doing good. So I am looking forward to learning more about how you use Mortgage Coach. You have done, I think it's over 2,800 TCAs. That's a lot of Mortgage Coach reports, brother.
Yeah, we do quite a few.
How long have you been on the Mortgage Coach team, getting after it?
Originally since like the PDF days, 2006, 2007, and then switched over to the digital platform, I think 2011, right around there.
I like the way you think of it. Oh, go ahead.
Yeah.
Go ahead.
No. I was gonna say actually, Kai McBride is the first guy that turned me on to it. He was my manager in California. He's like, you got to use this. So it's been a long time though.
Well, I love that. And Kai McBride, if you hear this, thank you for referring Sean to us. and I do want everybody to make note, he put it in the time, the PDF days. So back when PDF was like a modern way to do mortgage business, we were the first to give you a way to give a PDF to a family. But now that we are in this dynamic link, everybody's on mobile devices. There is an even better way to deliver advice. So tell everybody about what market you're in, a little bit about your mortgage practice, and then let's get into some big ideas.
Yeah, so I'm in the DC metro market. So it's kind of DC, Southern Maryland, and Northern Virginia. Everything inside the Beltway and a little bit outside. Now it's expanding a little bit. Producing branch manager. My personal production was about right under 75 million last year. And then the branch was about like ×2. We brought on a lot of new people in the last few months. So currently I think it's at like 13 producing loan officers in my branch. Nice.
So you are busy.
I am busy with a 4-year-old and a 1-year-old, and that, yeah, there's a lot going on.
Wow. So what are your goals for both yourself and the branch in 2020?
I'd like to scale up on my business about another 20%. The branch I'm hoping to have with my production right around $500 million would be give or take.
Well, that's those are big goals. So I guess
yeah, and my wife not kill me. That would be the next thing.
So yeah, no doubt. So I can imagine you're always looking for ways to do the same work faster. You're always looking for efficiency and effectiveness.
Yeah. 100%, and that's
why don't we start with that? How does Mortgage Coach and the advice platform that we have help you, be more productive and more efficient?
So, I mean, across the board from the beginning, one of the things, and I think DC is similar to a lot of markets, two things. Geography is a nightmare. So you can be 10 miles from somebody and 2 hours away. So when I first moved out here, figuring out how to communicate with clients was very difficult. And your guys' digital platform and video platform really helped do that. So I could really kind of have a presence without being present. Which was a huge boost to my business. So I could kind of, instead of driving 2 hours, having one appointment for an hour, I could have 15 appointments before 10 and send them out the emails as they went. Another thing it's really done, which I think has saved more time for me even than that, is we don't live in not too many households in Northern Virginia are single income households. So we got dual decision makers, and trying to set up times where both people can talk at the same time, virtually impossible, and having to constantly re-explain things to both parties. Where, I mean, I've been married for a while now, so if I try to explain something to my wife, it's going to start a fight. Like if it's not in both of our lanes, it's a problem. But having them be able to sit down, watch the video, and go over it and really digest it at their own pace without having to explain things to each other, cut out more time than probably any efficiency I've had in the mortgage business, whether it's online apps or anything else, but really being able to have 1 or 2 conversations as opposed to 3 or 4 conversations where things are getting convoluted changed my business. It just became so much easier. And then being able to do presentations and correct stuff on the fly and all that kind of stuff, great too.
Well, I love what you said. And to have a presence when having a presence is hard. And let's face it, guys, in today's world, having a presence, even when you're face-to-face with someone, is hard because you're face-to-face and we've all got devices. So I think, and I think it's important to acknowledge you need to have a presence on that mobile device, and it needs to go beyond the transaction. So everybody in the mortgage business now has the ability to take a transaction in a multi-channel way. That is not a competitive advantage. That's table stakes. Like, hey, here's my link, fill out an app. But being able to deliver mortgage advice in a way that's on a multi-channel experience, that's valuable. And then I like how you're clear that, hey, I've got multiple decision makers. And let's face it, in most mortgage transactions, there are multiple decision makers. And there's always multiple influencers. So Sean, let's just go through your perfect loan process, if you don't mind, on a purchase strategy. Just take us through what's it like for you to drive a purchase experience.
I mean, it starts with an online application from a referral. Go from there. They do the online application. I usually start with a really quick, Oop, am I back on? Look like it muted me for a second.
No, you are here, my friend.
My bad. Something just popped up. So normally it's an online application. I'll give them a call at the beginning, just kind of get an idea of what they're looking at doing. From there, I have them send me an example property, and I forward them over a mortgage coach link with a video going through, just based on the application, our initial conversation, the thoughts that I think would work out best, or the programs I think will work out best for them. And that's really our starting point. From there, we get to, it really adds a lot more context to the conversation. And I'll have the initial review while usually on the phone with them while they're looking at the mortgage coach, let them look at the video first, and I'll get on and we can make little changes as we go. And then after that, we collect documents or everything else. But normally I've tried over time, and there's always the outliers where we get stuff on a Friday night and then it's Saturday and they really don't have time to kind of digest anything. I'd like to get people at least a month or so out so we can really dive into every different structure, because it's people's thoughts about money, like what they want in down payment, what they want in other things. It's without really any context. They're just told, hey, I want to put down 20%, or hey, I don't want to pay MI. And sometimes those conversations, it takes more than one conversation and showing them the stuff in context before they really start looking at it going, this might not be the best way for me to do it. So perfect loan process is about a month out at a minimum, starting in the shopping process, showing them things, and then showing them how we can structure it to really put them in the best position over time.
So getting that, and guys, we're talking primarily pre-approvals for purchases, referral from a realtor. Do your realtors like that you give this mortgage coach total cost analysis? Are they in on that, or how do you integrate them or not integrate them?
Yeah, 100%. Like for the most part, I mean, most of them I'm working with forever, and initially they loved that they could see when the clients would open things up, because it would really give them an idea of just the level of interest, especially on open houses and things like that. Now it just keeps everybody on the same page and keeps everyone accountable. And then as the clients are changing possibly what they want to do for down payment, price points, other stuff, it lets them look at it. And then a lot of times we're in a really competitive market right now, and depending on how we structure it depends on what they're going to be asking on an offer. So I'll get the agent on there sometimes with the client and say, look, we can do 10% down and ask for no closing costs. We can do like 5% down, ask for all closing costs, or kind of just back it around from there. And then you guys let me know how competitive this particular offer is. So it gets everybody involved, and not just the client's finances, but also in the best way to negotiate deals based on the current market.
Interesting. Okay. So guys, it's more important than ever that we collaborate. We have a collaborative process to communicate with both realtors, with borrowers, multi-decision makers. So really think of Mortgage Coach as that platform that you're using to communicate options. And it's also valuable when you hand it off. If you have a team and you hand it off to a member of your team, now they know what was quoted to the client they know what was presented. That came out in my recent site visit with Jeremy Forcier, where his assistants and his production partners loved Mortgage Coach because they knew exactly what he communicated to a family. So let's talk about what are some of the most common strategies that you're presenting in the market right now.
Showing the power of discount points right now, just because margins are super compressed, and a point can get you 3/8 to a half a point. So sliding down payments back for people that want to put down 20%, and then sliding it down to like 17 and paying the difference in discount points and upfront mortgage insurance has been something that's been very useful. Explaining mortgage insurance to clients, because there's so many different ways we can pay it now on conventional loans. And it's still got like the worst PR guy of all time. Like, I don't know who the PR guy for mortgage insurance is, but he needs to get fired like yesterday. But it's gone a long way to kind of explain the different ways we can structure it. Those have been kind of two of the most prevalent. And then also we do a lot of bond loans here, just because it's very odd, and showing how sometimes down payment assistance is not a bad thing. If you're saving, 3 to 5% in closing costs to change your monthly payment by $150, and the break even sometimes really makes sense.
Got it. Well, let's pull up a Mortgage Coach TCA on your side, and let's go through a strategy, how you would position it with the family. And I guess let's just start with that. Like, how would you position the total cost analysis with the family? Do you call it a total cost analysis? And if not, how do you position it, and what do you call it?
I have a Mortgage Coach comparison, total cost analysis, kind of either one, or I'll name them specifically to kind of what we're doing in the link that I send them, like, hey, loan option comparison, MI comparison, whatever you want to do. Or I'm got a kind of goofy sense of humor, so sometimes I'll name it the best option for you, trust me, or something like that. The other guy's not as smart as me. Like, I don't know. Like, how can you do this and they can't do that? I'm like, I don't know. It's we just do. I think the first one though is this is just like a mortgage a different way of structuring MI comparison. So it's a couple 5% down options, one 10% down option, and then 5% with financed MI. In general, what we're going to see at the lower down payments, people are going to just say monthly mortgage insurance. I was like, giving the guy the benefit of the doubt, and I was like, he's at 3.875. That's great. Here's 5% with LPMI. That was the other option the guy was saying, and he wanted to see a 10% down option. What he ended up going with was the 5% down financed MI, where you're just taking a single premium and adding it to the loan amount. Costs were basically the same, but it's saving him like $80 between the 5% monthly MI and the 5% financed MI. And it's all, it's just a more effective way of doing it. And then the other one is what we've been doing quite a bit of lately, which is mortgage insurance, or trimming down the down payment and then paying discount points. So this client wanted to do 20% down. He was like, I'm doing 20% down. I'm not paying for mortgage insurance. You can't convince me otherwise. I'm like, not going to try to convince you otherwise, but there might be a more effective way for you to spend your money. And once, as he got into it, he was like, I just want to have the lowest rate because that's going to be the lowest payment. 20% down doesn't have MI. Okay. So if we can structure this where you're spending the same or less money and your interest rate's lower, does it make sense? And we kind of got into it a little bit. I was like, all right, here we go. So 3.5, we can buy your rate down with 7/8 of a point, saves you a little bit of money over 20% down. Going all the way down to less of a down payment at 17.5%, paying 2 points. That day we could buy it down to 3.25. And this is going to be this guy's forever home per him. Over the first 15 years, he was going to save roughly $21,000 in interest. So for him, it ended up being a no-brainer. And that's something we've been doing really a lot of lately, whether it's at 20% down, 10% down, 15% down, just showing people how putting your money towards discount points can sometimes be more effective than just throwing it at equity, especially over time.
So let's do this.
Mm-hmm.
If you could stop sharing your screen, I just want to call out the fact that I'll guarantee you that customer found out something they didn't know. Like they thought they needed X loan, and through a conversation with you and through the presentation, they learned something they didn't know, and they ended up picking just the combination of rate, payment, down payment. It was different, and your advice and ability to do that was unique. Is that right? I mean, is that kind of your goal with most of your clients, is to get them to look at their mortgage differently?
It's to get them to look at money differently, as well as just their mortgage. Something we get a lot of, and I think people's feelings towards money has changed over time, where it used to be the most conservative thing was you throw everything at your down payment. And I try to at least give people all the options. I'm like, my general advice to people is I can make stuff make the most financial sense in the world, but if you can't sleep at night thinking about it, go with the one you can fall asleep at. Because if you have a heart attack during the transaction, it doesn't particularly matter. But when you're looking at the difference between, like, on a $200,000 purchase, you're looking at the difference between 10 and 20% down. That's easy. It's $20,000 and it's about $100 a month. There's not too many times where saving $100 a month but spending $20,000 makes all that much sense. And if you are in a single income family or it is your starter home, it doesn't particularly matter if your mortgage payment was $1,500 for 8-9 months. If you lost your job, that $100 in savings that cost you $20,000, you're not gonna be able to make the $1,500 or $1,600 payment anyway. So it's actually more conservative sometimes to put down less money depending on your overall life circumstance. And we have very long conversations kind of retweaking people's thoughts about what's actually conservative. And that's, I think, going back. Go ahead.
No, you go ahead. Finish. I didn't mean to.
No, and I think it's I think it just no worries. I think it goes back to like living through the crash. Like most people didn't have as much problems regarding equity, went from 2 income families to 1 income families, and didn't have savings. Like the people that had savings tended to kind of bear the brunt a lot easier. So it changed the way that I look at money as well. And liquidity, as long as as long as it's leverage and not extension, is a good thing.
No doubt. Well, let's do one more strategy. I know you've got an MI analysis, and
I think I pulled up the
how often do you do a video and put a mortgage coach video on your TCAs?
On pretty much all the initial ones, I'll do a video. And anytime where there's been something that dramatically changed as far as the structure, I'll do a video. And it kind of goes back to the initial part of the conversation. One of the most powerful parts of the tool is not having to explain it 10 times. So if there's anything that is going to be different than a previous analysis, I'll add a video again to it. So as much as possible.
Got it. So make note, everybody, he's giving them options. He's giving them a link. He knows how to have the live experience, and he knows when and how to put a video on it. It sounds like you're putting a video on it almost every time right now.
Doing my best to, pretty much every time, yeah. Let's see. All right, and I think I might have been fiddling with this one before, so it doesn't look as accurate as it did. But this will give you a gist of the like a general MI comparison. There's a client that was looking at a couple 5% down options, and what he was given previously was 5% down with monthly MI and an LPMI option. I had added the 10% option, but the option that I really wanted to show him was financed MI at 5% down, and he really just hadn't heard of it. So looking at the 5% down option compared to the monthly MI option, you know what? My assistant went in and changed all the numbers on this. Hold on a second. I apologize. It's got different sales price. Let me,
No problem. Let's watch you. I mean, folks, you know, notice he's looking at the consumer part of it. Notice some changes. He's going in real time, making edits. You could also be making these edits from your mobile phone, but obviously you can tell the man has created a few TTAs. Look at him go. This is good. Boom.
all right. So let's see,
Did
the
you get it?
5% finance. Finance IMI option didn't bump back up yet, but it should. There we go. All right. Yeah, that makes a lot more sense now. All right, so Alex fired, but everything is in line now, so that's perfect. So what we were looking at on here was a couple 5% options. The options he was getting from the other lender at the time was a 5% monthly and a 5% LPMI. What I really wanted to see was a 5% financed MI. So if you're comparing the two, closing costs are going to be the same, obviously, with all the 5% down options, no discount points or anything else. He had never seen financed MI before, which is just taking a single premium, rolling it in the loan. And compared to the monthly MI, which was kind of where he was leaning before, even at a slightly higher interest rate of 4%, we're saving him $103, which is really the equivalent of this loan amount of about 3/8 in interest rate. So kind of retraining them that, yes, there is monthly MI. Yes, your rate is lower, but your effective interest rate is actually 3/8 higher, because it really doesn't matter what the number is if you're paying the equivalent. So that ended up being the option that he went with. And even compared to the LPMI option, we're still saving him like $20 at the quarter lower interest rate. So a lot of times it's just, these aren't things people see very often. They're not going to understand it right off the top, but getting them the information, letting them see it, letting them just see raw numbers and be like, oh man, the interest rate is higher, but my payment's lower. Okay, cool. That ends up making more sense. But I think the consumer's been trained so much that interest rate's the only thing that's important. It takes them a little bit longer to understand that structure of a loan is actually half the time more important than interest rate alone.
No doubt. There's a lot of variables. Let's do this. Let's stop sharing. So everybody who's watching this, if you want to see examples of these total cost analysis, there'll be a description down below. You got the walkthrough. Let's talk about how you take a customer from what's your rate, like, hey Sean, what's your rate, to, you know, hey, I'm going to answer that however you would say it, but you get them into that like structure and strategy, and you know, there's a more strategic way to make a decision. So what's that sound like? You know, if someone says, what's your rate? How do you take them somewhere else?
You know, normally, I mean, a lot of the what's your rate talk is taken some time. Really coaching your referral partners is a great way as well, to where I used to get it every time, like, what's your rate? I'm like, wow, we haven't even met, and that's where we're going. But I found out that all my referral partners were telling people Sean has the lowest rates. So I didn't really have any other place to start. Like, that was just the expectation. So first thing I started doing was talking to my referral partners and being like, hey, why do you like working with me? And like, they would say, oh, it's mortgage coach, or, you know, you structure loans differently. You give people more advice. I'm like, cool. Well, tell them that. Don't tell them I have the lowest rate in town. And that's going to help me a lot, because it's not putting me at a disadvantage of having to back out of everything, because I just don't have the lowest rate in town. We're competitive, but we're not going to be the lowest guy. But still, some clients, it's just what they want. So I just start off in the beginning. Hey, fill an application, send me an example property. I know you said you want to do 20%, but I'd really like to show you some different ways to structure the loan. And then you tell me what's going to work best for you guys. And normally I'll just let the kind of analysis talk for itself. Like, I think what people don't understand is they really think there's going to be this massive savings based on larger down payments and other stuff. And then when they see the number, you know, name that loan amount, it's not that big in comparison to the loan amount. And it's always, I think, a little bit shocking when they see everything side by side, that for the cost of the lower payment or for the cost to get it to 20%, the juice just isn't worth the squeeze. And once they see the context of it, the conversation gets a lot simpler.
Love that. And I love the way you talked about how you've trained your referral partners, and that your referral partners, they don't just think of you as the low rate guy or the transaction guy. They think of you as the mortgage strategist, the mortgage coach, that you need to talk to my guy, and he's going to help you figure out the right structure, the right down payment, the right program. And so they're not coming into you, what's your rate? They're coming into you, I heard you're going to help me figure out the right way to finance this home. And that's a much better conversation to start from. So let's go into a wrap-up mode. If you got value from this conversation, everybody watching it, give us a like down below. Share this with your mortgage friends. Sean, for any loan officer that's watching this that isn't using Mortgage Coach, or maybe they have it and they're not using it with every client, what advice, what leadership do you have for anyone that just, go from using it once in a while to use it all the time? What advice do you have?
Well, advice and kind of an observation. One, I don't think there's an easier tool as far as lining up as many things side by side, showing as much information in a very simple to follow format. So you're kind of nuts if you don't. There really hasn't been a tool that's been to date that I'm aware of that does everything that Mortgage Coach does as easily as this does. And it's easy to work on the fly. Two, and this is kind of anecdotal, but over time, clients used to think this was just neat. Like my picture would just kind of pop up and they'd be like, oh, that's cool. There's a video of Sean. That's what Sean looks like. Neat. And, this is all kind of, it was more like a bell and a whistle. But over the last couple of years, it seems like clients or consumer personalities or what consumers want has actually caught up to Mortgage Coach. So this is going to, I think, a platform like this or something that's going to be similar. It's going to not be clients are going to demand it in some form or another. They're going to want to have a digital platform. Like people are already asking me to do like Zoom calls and things like that to where I can explain all this. I'm like, don't need a Zoom call, got Mortgage Coach. Here's my video, here's everything else. We can do it. So if you're starting off, especially if you're under the age of like 35, which would be like a rookie loan officer age these days, you just get used to it. Use it now because it's going to go from being a novelty, which sounds wrong, but it's the only word I can think of, to being something that your clients are absolutely going to demand that you do something in this format. So just get used to it now because it's going to make your life a lot easier, and you'll be a lot more successful instead of having to kind of pick it up on the fly down the road.
No, I love that. And we've worked hard to make Mortgage Coach a platform. It's not just about loan comparisons. It's about the most efficient, most effective way for a family to get advice so that they consume it, they understand it, they make the right decision, and then to do it in a way that all the decision makers are in the loop. A loan officer, even if you don't have a team, you've got a processor, they know what you presented and quoted. And if there's a referral partner in the loop, they understand, what is the mortgage strategy here. So Sean, dude, I appreciate you making time to add some value to the bigger Mortgage Coach community. And I'm looking forward to doing more stuff with you and your branch and more stuff with you and your region.
No, I appreciate it. It's been a lot of fun, man. Thank you.
All right. Take care, brother. Have a good one.